How's it going out there? It's Tuesday, January 18th, and you're listening to the Wall Street Unplugged podcast, normally hosted by Frank Curzio, but once again, he is traveling, boots on the ground research, meetings of minds, pulling of strings, deal makings going on. And in his place today, once again, hi, Daniel Creech, senior analyst here at Curzio Research, and filling in for him behind the mic for at least today and tomorrow. We'll see how the schedule unfolds, but I'm excited to do this again. I had a great time a couple weeks ago while Frank was in Las Vegas at the Consumer Electronics Show, and we're going to have a lot of fun today. Normally, Frank hosts the Wall Street Unplugged every Tuesday, Wednesdays, and Thursdays. Tuesdays are his monologue, which I'll do today. And I don't know if he has a guest lined up, so just kind of bear with us. A lot of exciting stuff, a lot of moving parts going around here to kick off the new year, and we'll all get through it together. Earnings season. Well, I got to say, I love having a rough outline to cover the podcast. I love the prep work. I love doing everything about this. And then you come to work, you get here early, you get all your ducks in a row, and of course, fun events happen, life happens. Markets are down, yields are going higher with this constant inflationary mindset and the Fed hiking, projected hiking coming. Bill Ackman was out with a good tweet I'll cover in just a minute. But Microsoft takes the cake today. Microsoft announces a huge deal, all cash, to buy Activision Blizzard for somewhere around, give or take, a 40% premium to closing, its recent closing price. Talk about just highlighting the metaverse, highlighting gaming, macro play, and writing checks. I think they're spending around $70 billion, billion, just going to write a check. So lots to talk about. Earnings season. Delta Airlines, earnings season's well underway. The big banks are reporting. Goldman Sachs reported this morning. JP Morgan reported last week. They even noted of strong consumers, strong conditions. Their results were positive. Goldman missed on earnings per share, but I think beat on revenues. My point is they were solid in general, because when you're comparing these to last year or previous periods, remember, comparable sales, comps, you want to put everything in context. So, hey, we're doing great over here compared to what? Well, for the airlines, for Delta, you're not going to compare earnings or losses to the 2020 year because the coronavirus locked down everything. Nobody was flying, so that's basically a wash. What I like about Delta is they are comparing to 2019 to try to give investors and everybody the perspective, the context of how they're performing given the environment. Lots of risk out there, of course, but Delta came out, JP Morgan, everybody's talking about inflation, higher costs across the board, but JP Morgan and Goldman Sachs' comps were against very solid quarters, very high earnings. Those are fluctuating a little bit. JP Morgan dropped, sold off after earnings last week. Goldman's down roughly 4 or 5%. Thesis is still intact for Curzio Research Advisory members, up big on Goldman Sachs. That's just a great bank. I'll sift and go through the details, but overall, in a higher interest rate environment, yeah, trading might be tough, but overall, that thesis and that juggernaut is probably going to continue to be a solid place for investment capital. Switching gears to the airlines real quickly, because I want to help continue to paint the picture, unfold the thesis of the recovery trade as we look past the variance and, this quote unquote back to normal, back to 2019 issue, with comments and perspectives from the CEOs who are behind all this. And the reason this is important is because this narrative, as the narrative shifts and the majority of people or businesses and or politicians move away from lockdowns to open economies, that's just good for everybody. And I want to explain that and kind of continue on that thesis. So Delta reported earnings. I'm not going to get into those details. I want to focus on what the CEO said on. He did an interview with CNBC afterwards, and then a few conference call transcript quotes. But first, on CNBC, Ed Bastian says the worst is behind the airlines regarding impact operations due to Omicron. If you remember a few weeks ago when Omicron really started to hit the headlines and spread, and it continues to, I'm not ignoring anything there. The case count and all kinds of stuff is continuing to move higher. The point here is they are saying that Delta's saying that flight cancellations are way down over the last few weeks. And get this, and this is just great this is just positive news in general. 8,000 staff members were infected. He's referring to Omicron, but all of them are fine and there were no health issues. That's wonderful. Just in general, like I said, for humans, for the economy, for everything. That's a great stat, and that's positive to hear. The holiday season was the busiest travel period in 2 years. Again, put everything in context. What are your comparables to? That makes sense because the last couple years, starting in 2020, have been volatile as can be after nobody was flying in 2020. Bookings continue to remain robust because people know Omicron is not a threat to them. That is a hell of a powerful statement from the CEO of Delta. Again, what's driving his thesis and results? He's looking at the bookings. He's looking about the business, the services that he provides, and how the customers are responding. And he says the company is prepared for higher oil prices. Regular listeners know that I've been bullish on oil. Frank has been too. As inflation continues, I expect commodities and oil to continue higher. Oil today is it's closer to $85 a barrel than it is $84. That's up. It's been a steady track higher. But the point here is, I don't want to get off on a rabbit trail. I'm sorry. Delta Airlines, these are hugely positive comments for the economy in general, as far as an open versus closed standpoint, and as far as people's perspectives and feelings towards fear of going out and doing something, contributing, i.e. buying goods and services, providing goods and services, the ability to do that are trending in the right direction from that standpoint. A couple of conference call bullet points here. He believes that, again, this is referring to the CEO or just management, believes given the high transmissibility and low severity of Omicron, that the variant is, quote, likely to mark a shift in COVID-19 from a panic to an ordinary seasonal flu. How do you play this out? Why am I going through this macro trend? Because airlines is one way to play it, because they were so hurt and so beaten up, and the industry is not going anywhere. And you can benefit as this recovery to normal. From a seasonal flu standpoint, if that mindset is not going to hinder a lot of operations, that's a positive. Again, we've talked about the pharmaceutical industry and how you can have exposure to that. Pfizer has long been the low-hanging fruit, in my opinion, on how to do this and how you go from the narrative of curing and eliminating the virus to treating it. So remember, we've had this direction or this conversation about getting rid of it completely, shutting down the virus, not shutting down the country, to more of, hey, we're going to have to learn to live with this and we're going to treat this. So Pfizer's treatment's different. Pharmaceutical companies, like I said, Pfizer's just the lowest hanging fruit on that. But this is, again, from Delta, which is a positive thing. That's what he is saying. Okay, you can agree, you can disagree. That's what he's saying based on the data he's looking at from his business. Couple more here, expects the recovery. Expects rates of recovery step down in January because they did have some staffing issues and all that kind of stuff. But January to February is going to be about 70% of 2019 levels. We're nowhere near. That's a big deal from, if you want to compare, hey, when are we getting back to 2019? Well, he's projecting going forward, and this is over bookings and different things, roughly 70%. We're not there yet, which is the thesis that Frank had behind Delta. As we get back there, Delta's going to be able to cut costs, manage that business, and be profitable, and reward shareholders, of course. So Omicron variant has greatly impacted operations. Again, we're looking in the rearview mirror, so he's talking about why they expect a small dip in the first quarter here, and then they'll get through that. So that's just a little bit of, boy, this is a terrible pun, but a little bit of turbulence, if you will. But to recap, the CEO coming out and having very positive comments on his staff, and I don't want anybody to get affected with anything or ever feel bad, but I'm glad to hear that several thousand, 8,000 were infected, and there were no health issues there. So that's a positive. Hopefully that is a domino effect, and we start seeing that more and more across corporations, across staffing, across all goods and services. That's just a real positive thing. So that thesis continues to play out, and that's a positive for everybody. Continuing on with CEOs, I want to switch gears this morning. BlackRock, Larry Fink, BlackRock, they got to be the largest, huge investment manager, just absolute juggernaut of 10 trillion-ish assets under management. He was on CNBC, and he was talking about he expects higher inflation and aggressive Fed. And I'm going to use this as a segue to something that Bill Ackman tweeted about, and I think is worth noting, because as we get closer to Fed meetings, you're going to continue to see volatility like we are today and like we have all year. So Larry Fink said, a couple bullet points here, some of the inflation was created by sustainability measures. Increasing wages are a blessing, but the question is, can companies pass on wages and maintain margins? So just like airlines, if you're only operating at 70% capacity, give or take here or there, are you able to cut enough cost? Are you able to charge? Do you have enough pricing power for those customers that you are serving to strengthen your bottom line, to manage your business, to grow your business, to reward shareholders? This is something that everybody is going to have to continue to deal with. This is the new normal. And from an investor standpoint, I want you to think about the new normal and how those businesses that you're investing in, you're buying a piece of a business, how is that going to operate in not only the current environment that we're anticipating and seeing rising interest rates and higher costs, but then to sustain through that period where you have that as a constant. He believes the U.S., so quickly, that pricing power is important because low-hanging fruit, McDonald's, you could argue, has great pricing power. They can, the one here on the island that I go to every once in a while, I try to do everything in moderation. You see the constant switching of deals. It was 2 for $4. Now it's buy one, get one. I'm talking about their breakfast, which I am so biased and think McDonald's has amazing breakfast. And I had a friend of mine tell me it wasn't as bad as I thought. How much more general can you get for justification? So I said, well, it's not that bad. So how that will affect, will companies be able to pass on wages and maintain margins? That's a big red flag to watch going forward, or a big signal. Larry also believes the U.S. will have higher inflation over the next year and an aggressive Fed over the next 2 years. Now he's counting, put that in context. That's a big theme today. He's counting this year and next year, so 2022, 2023. An aggressive Fed, hold that thought. And two more points from him quickly before I get on to the Fed. He thinks earnings will surprise to the upside. That's a positive. He believes deficits matter. Okay. And he thinks stock market gains will be muted going forward. Now I'm just looking at the bullet points here on one of our services. So I'll dig into more of this and continue to update you. But that's an important thing because you want to learn, I don't want to sound like a know-it-all. You want to think about the expectations and how those are going to play out in reality. And let me explain that. I don't feel like I'm doing this just. As Frank likes to talk about, markets hate uncertainty. So if you have high expectations going into an earnings season and they come in lower than expectations, you're going to see more volatility because it's a shock. It's an awe factor. It was something that wasn't prepared for by investors. It took them by surprise. That is something you need to constantly think about. And so here you have the largest asset manager CEO talking about, hey, your expectations going forward ought to be tamed down. We've had a great couple of years. I highlighted a couple weeks ago, or Frank and I did, last year the S&P 500 was up almost 30%. Those are much higher than your traditional 10% averages over a long time, or 8.5%, depending on what kind of how far you want to go back, the 20, the 30-year, long-term compounding of wealth. So expectations going forward need to be tamed. Need to be lowered. That all transitions or translates into the reality of volatility and possibly lower prices, lower asset prices across markets, across the Dow, the S&P, the Russell, the NASDAQ. So keep that in mind going forward. An aggressive Fed over the next 2 years. Bill Ackman has come out and he tweeted, I believe it was a few days ago. Today's the 18th. I think this was from the 15th. Yes. And he says, while it has become conventional wisdom that the Federal Reserve will raise interest rates 3 to 4 times this year to mitigate inflation, the market expects 25 basis point increments. The unresolved elephant in the room is the loss of the Fed's perceived credibility as inflation fighter and whether 3 or 4 would be enough. I'm going to take a break here from his tweet. So the perceived credibility, because we've talked extensively as the Fed chair, Jerome Powell, does his press conferences and updates and testimonies about how he is trying to guide this economy, about how he's trying to be transparent and to communicate with the market, i.e. investors, because like I say, he watches the market and they don't want to cause a market crash. And nobody does. I get that. I'm not saying he should or whatever. I'm simply saying that I believe that he watches asset prices. He's trying to manage the economy. He's trying to manage everything. The perceived credibility is when Frank talked about when they did a complete 180, when he threw away the transitory inflation remarks and said, hey, it's going to be here. It's here to stay, essentially. That was a couple of months ago. Frank thinks that they're going to hike even more than expected, so 4 or more. And if you remember our conversation a few weeks ago, this is a great point and also reiterated by Bill Ackman. You don't have to do the 25 basis point increments. You can do 50. You can do anything in reality to an extent. You can say, hey, let's raise it XYZ. Let's bump it by 1%. Now, I'm being a little silly there just to prove a point. Bill Ackman's point is, hey, this would give you a lot of credibility. It would shock the market, so it would be painful. And he even highlights that in one of his tweets, because it was a couple, 2 or 3 tweets. What kind of pain would you see there? Well, you would definitely see, the easiest thing to think about would be markets would swoosh lower. You would have a quick drawdown while everybody basically hits the sell button first and then ask questions later. But just like he pivoted and shocked a lot, with the transitory to more constant inflation, if he did come out in, say, March or whatever, when the first Fed meeting that Goldman Sachs and other banks have pulled forward, if he comes out and does that, that would be a buying opportunity in certain sectors where inflation, remember, that's not going to fix anything. So if the market goes down 3% from here in general, you're going to have a lot of stocks that are down significantly more than that. If those stocks are in certain sectors, commodities, goods, different services, different products, those companies have pricing power. Those are going to be excellent opportunities to look at for investors to buy up shares. So just like Larry Fink is telling you to kind of tame your expectations, you're not going to get 20 to 30% a year like we have in the past, or at least the last few years, i.e. last year. Those gains he believes are going to be muted. Couple that with Ackman calling for a shock and awe from the Federal Reserve, just going to increase all the volatility. One more thing on Larry Fink's comments, and just to kind of couple that and show you how I'm trying to put this puzzle together. There was a solid report out of Bank of America last week, and they were giving their take on believing like cash is basically going to outperform the market. 2022 is going to be a down year for equities, meaning it's not going to be positive vol. Now, that doesn't mean it could be down 10% or 20%. That simply means that they don't believe it's going to have a positive return. For asset allocation, they point out that they believe that cash can outperform equities, which is rare. It's just twice in the past 30 years, which was 1994 and 2018, were both Fed shock years. But there was this long period of stagflation where you have, constant or leveling off of wages and much higher prices. So any wage increases are offset by higher prices, which doesn't do consumers any good. That era, and I know numbers are hard to follow, so I apologize, but they're just pointing out that, hey, from 1966 to 1981, cash outperformed stocks and credit 7 out of 16 years. The point is they're thinking, hey, history doesn't repeat itself, but it can rhyme. And if you have these negative years, these Fed shocks, which is kind of what Ackman is talking about, or what Frank has been talking about, saying, hey, if they do surprise, like the transitory issue deal, that's going to cause significant volatility, and those prices are going to move lower. I'm not saying sell everything, go all to cash. I'm just pointing this out to try to build the environment, put in context of what we're in now and what we're going through this year and in the next as we have higher prices across the board. Hopefully that makes sense from a macro level. And finally, I want to just discuss this. The Microsoft is a great deal in the sense of it shows you that, hey, the world continues to move forward. There's a ton of volatility. Activision Blizzard was going through a lot of bad press, a lot of investigations on corporate, not accountability, but environment. Well, accountability is in there. I don't mean to throw that away, but a lot of investigations on management and corporate style and the environment of working there, and it's comfortable, is it fair, and all that kind of stuff. So their stock has been drifting lower. Microsoft comes in and swoops it up with all this in higher interest rates, with all of this noise going on with what the Fed's going to do. Where are you going to see struggles with ebbs and flows of higher commodities, consumer spending, and they're looking long term. And as investors, you can take away from that and think about that. Hey, the world is not ending. Even if the market, quote unquote, crashes, you've been through market crashes before. Unless the world ends, you got to look for opportunity. And, if the world ends, then it doesn't matter. That's a silly cliche. But this is just a good macro perspective of saying, hey, look at these largest corporations in the world. They're looking through all this noise. They're still trying to find value. They're still planning on the future. They're still investing on the future. Again, I don't want to get ahead of myself. I've just looked at several headlines as the news has been breaking this morning. You keep seeing references to the metaverse. I'm going to listen to some interviews coming up with Microsoft of Gaming and Activision and put that together. Again, I'll talk more about that tomorrow. But I do love the timing. It's coming off of a holiday weekend. They're doing all this. That's just good stuff. And I hope that helps tie in from how to look through the noise and don't be blindly bullish. Just keep an open mind to opportunity, because as prices move lower, as volatility increases, that increases the opportunity. That increases the ways to win, the more ways to win. And as investors, as stock pickers, for us, we couldn't be, you don't like to go through painful times, but you want things to kind of trade on, their own theses. A rising tide lifts all boats. So from our perspective, we'd rather want to shine in a good environment. We want the environment to where we can shine and provide value. And that's what we're expecting and looking forward to. All right. So just a few topics here, a little shorter today, but that's typically my style. Please send your feedback, good and bad, to me at daniel@CurzioResearch.com. That's daniel@CurzioResearch.com. I'm only doing the audio for when I sit in with Frank, but continue to follow him on Twitter. Check out our Curzio research page, our Curzio YouTube page. Also follow Frank on TikTok. Love building a social media presence there and appreciate all followers. Again, all comments and everything. We will... We'll pick up tomorrow. This has been great filling in, and I hope you guys have a great rest of the day, and we'll talk about a lot of exciting events, including some more stock ideas tomorrow. Cheers.